Good morning, everybody. Thank you for joining us on this, at least in the upstate, very rainy morning, and spending time with us. If you have been, if you were on a call a couple last week with us about Giving USA and reports on individual giving in America, this is going to be a really good follow up. And if you weren't, don't worry. This is an excellent presentation from Katie Warlick, who joins us from CLA out of their Charlotte office, to talk about the impacts of tax policy on nonprofit giving and sponsorships and the like over the starting in, well, this tax year, really this current tax year in particular. We're really excited to have you guys here today. And if you remember, and Katie will cover a lot of this, but last year, the One Big Beautiful Bill Act was passed into law, which had a lot of sweeping reforms to a lot of different programs that a lot of us were paying attention to, but including tax policy and individual giving and corporate giving. And so we've asked Katie to come give us an overview of those changes. And Katie, I'm about to turn it over to you. So if you have questions, as how you said, throw them in the chat throughout this, and we'll pepper them throughout. Take Katie and Heidi's lead on weaving those in. Katie is a certified public accountant with CLA's National Exempt Tax Practice, where she specializes in tax compliance and consulting for nonprofit organizations. Before becoming an accountant, Katie served as a nonprofit development director. So she is one of us, giving her a unique perspective on the challenges that nonprofits face. She combines deep technical expertise with firsthand nonprofit experience to help organizations navigate today's evolving tax landscape. Katie, thank you so much for being here today, and looking forward to everything you're going to be sharing.
Thank you, GP. It is great to be here. Great to see you again. I am going to go ahead and share my screen. All right, so now we are looking at my fabulous presentation and hope that my technical skills will be able to keep up with this. So I did not do an agenda slide this morning. I apologize, but just to kind of give you an overview of what to expect, I'm going to start off talking a little bit about who CLA is, because I'm sure a lot of you have no idea who we are and what we do. Then I'll talk a little bit about the changes that came about in last year's tax legislation, and then how they may change donor behavior in some ways, and then look at some strategies to navigate that new environment. As both Heidi and GP said, please feel free to use that chat to drop questions in, share how you've been impacted by those changes and responses. Heidi has been kind enough to put together some polling questions for us. I am hoping that she will pop those in as they are appropriate, because I have a feeling I may get a little distracted with the presentation. So, and I'll take a couple of breaks along the way to stop and see if there's any questions that I can answer at that point.
We got you, Katie. No worries.
Excellent. Thank you so much. So at CLA, we have to start every presentation with a disclaimer. Today's presentation is providing general information only. We are not lawyers and we do not provide legal advice. Our recommendation is that you consult your professional advisors for information on your specific circumstances. You heard a little bit about my background. This is just kind of the overview here. I am very fortunate to be in a role where 100% of my time is working with nonprofit clients. I work with a variety of different organizations, lots of different missions, lots of different sizes, from those that are just bringing in, less than $100,000 a year to multi-million-dollar organizations. And it is extremely satisfying and gets me up every morning knowing that I play even a small role in helping ensure that they're able to continue to fulfill their mission by staying compliant with those IRS regulations. So who is CLA? We are a national professional services firm, which is a fancy way of saying we do tax and audit. But we do a little bit more than that too. We also do outsourcing. We provide consulting. We get into cybersecurity. We provide assistance with digital automation, integration, and even wealth management. We've got offices throughout the country, but we do have a very strong regional presence. We have 3 offices in North Carolina, Charlotte, where I sit. We also have offices in Winston-Salem and Raleigh. We've got an office in Atlanta. And we are building up our presence in South Carolina with teams on the ground in both Greenville and Charleston. Our Charlotte office recently moved from Uptown Charlotte to South Charlotte in Ballantyne, which is very near the South Carolina border. And we are very excited to have one of 3 CLA connection centers that are in the country. And that allows us to be able to host events for our clients and the community, including bringing in our nonprofit friends for nonprofit roundtables and some half-day conferences that give you that ever elusive and desired CPE. Nonprofits are a big, big deal for CLA. Nonprofit represents the largest industry that the firm serves as a whole. We've got more 990s filed. Now that's just 990s, not the PFs, not the 990 EZs or the 990Ns, just looking at 990s. Most 990s filed of any firm in the country, and we do the most single audits of every firm in the country. And this was really the result of a conscious decision by firm leadership several years ago to lean into serving our nonprofit friends. And this has allowed us to become a leader both in providing those professional services, but also to be a thought leadership position. So we have webinars, we have newsletters, blog posts, those roundtables and conferences I mentioned. All of those are available free to any nonprofit who is interested in subscribing, attending, whatever. All you have to do is go to the CLA website, which is called claconnect.com, and sign up, and you'll see all of that information if you're interested. So for this, I felt like this quote really kind of captured where we are today. It's from Bertolt Brecht, who is a German playwright and poet. And because things are the way they are, things will not stay the way they are. Now, I find this appropriate because my mother always tells me the way things were is not the way things are. And the way things are is not the way the things are going to be. Change is inevitable and it's constant. We can't get too caught up missing the past or get too comfortable in the present. Flexibility is the key. If recent history has taught us nothing else, it's flexibility. Back at the end of 2017, the last time we had new tax legislation that was significant, we were all pretty unsettled in the nonprofit industry by that change in the increased standard deduction and what that would mean for individual contributions. We had to learn some new fundraising strategies. Just as we started to get comfortable, COVID hit, and the word pivot became part of our daily conversation and really a key life skill. Today, we're looking at rapidly changing government priorities that impact not only our donors, but also the people that our organizations serve. Tax laws keep changing. Some of them have an expiration date where they only last for a year or two and go away. Some of them are considered permanent. Now, I need to say permanent in quotes. Permanent just means they don't have an expiration date. They're only permanent until a new group of legislators or a new administration decides to come in and pass new permanent tax legislation. So let's take a look at what the latest rounds of tax law changes are and the impact that they're going to have on potential impact on deductions for charitable giving. Quick review. Let's make sure everybody's on the same page about this. These are the new rules that came into effect last summer, that OBBBA, however you want to call it. But the impact is going to be different for different types of both individual and corporate donors. And once you understand how these may impact donor decisions, you can focus your development strategy and better understand your donors. So, we're halfway through the year. Have you seen any changes in your donor behavior? Or is everything just kind of the same so far? Are they not aware of some of these changes? Feel free to put some thoughts into the chat so we can know what's going on with everybody. So let's start with donors who take the standard deduction. We all know this is the vast majority of taxpayers in the country. And what they now have is an opportunity to reduce their tax bill by making charitable contributions, even if they take that standard deduction. This is considered an above the line deduction. And all that means is that it changes what the IRS calls your adjusted gross income, AGI, technically it's just your taxable income. You take what your earnings are, whether that's from your W-2, from 1099s, from your business, add in any investment earnings or interest, and now you get to subtract your contributions to get to the total that determines what your tax bill is going to be. The example that I've got here on the screen talks about a married filing jointly couple that makes a $2,000. That's the maximum contribution they can make, and what their savings would be. Now, in practice, this amount of savings is going to depend on the tax filer's taxable income, AGI, and what tax bracket they're in. One important thing to note here, if you get qualified charitable distributions, those QCDs from donor retirement plans, these are not impacted by that at all. Those contributions are treated very differently than direct contributions from an individual because they're coming through their retirement account. So they don't get counted in that $2,000 or $1,000 limit, depending on the taxpayer type.
All right, Katie, I'm ready to launch a poll. Ready?
Okay, great. Thank you.
Which donor segment is your organization most focused on in 2026? Go ahead and click your choice, and we'll see. All right, make your choice.
Okay.
We'll close it out in about 5 seconds. All righty. So, okay, and we're ending the poll. Yeah, it looks like it's pretty
Okay. We're all
clear.
over the place. I
Yeah.
like it. I like it. So there'll be a little something for everybody. That's wonderful. Thank you. So I'm going to shift gears now and talk about people who use the itemized deductions. That's Schedule A on your Form 1040. And these tend to be a little bit more higher income donors, obviously probably a little bit wealthier too. The biggest change is this increase to the SALT deduction. And SALT stands for state and local taxes. And in practice, what this primarily is that the deduction that you get for paying state income taxes and for paying your property taxes. When we had that Tax Cut and Jobs Act back in 2017, went into effect in 2018, that deduction, which previously had not been limited, all of a sudden got limited to $10,000, which meant that very, very few people who had significant incomes and had property that they owned were going to get the full benefit of those taxes that they paid. Starting now, the new law changes, and now married filing joint taxpayers are going to be able to deduct up to $40,000. This will be adjusted annually for the next few years until it reverts back in 2030 to the original $10,000. So this is one of those with an expiration date on it. What this all means is that there's going to be more people who will benefit from itemizing. And when you've got people itemizing, they've got more opportunities to deduct the charitable contributions that they're making. There are some limits that got put into place at the same time that this increased deduction for state and local taxes came in. The first is a floor. And what this says is that you've got to be, your deduction has to be greater than the floor, or your contribution has to be greater than the floor before you can deduct it. So let's say you've got somebody with taxable income of $100,000. That 0.5% floor is $500. The first $500 that taxpayer contributes will not be deductible on their taxes. What's above that $500 will be deductible. Gets a little bit more complicated because tax always does. And there are some income caps that will limit those deductions to a maximum of 30% of AGI taxable income for folks in the highest tax bracket. What I expect is that this is going to lead donors to really strategically plan the amounts and the timings of their donations to maximize their tax deduction. And you'll see that in the next few slides. Moving on from individuals, let's look at corporates. Now, Corporate contributions, when we're talking about these rule changes, these apply to C corporations only. These are the type of corporations that file and pay their own taxes. There's a lot of other businesses out there that are not structured as C corporations. Either they're partnerships or S corporations, and those are ones that may file tax returns, but the income and any charitable deductions from that business are ultimately reported and paid on the individual owner's tax returns, not on a business return. So this is just for businesses that file and pay their own taxes. In the past, these corporations have had their charitable donations capped at 10% of their taxable income. The new law now adds a 1% floor. So you've got this lower limit that has to be met, and then an upper limit that kind of squeezes in where those donations can be taxable for the business. So what does that mean? Likely, routine, smaller gifts may not hit that deduction threshold anymore. And so there may be some possible changes to those donation decisions. Now, while there may be changes, please remember that C corporations, this type of contribution is a much smaller proportion of typical fundraising dollars coming in than donations from individuals. So the overall impact to your organization may not be significant, but it's always good to have more information and be prepared to have discussions about the timing of gifts and giving budgets if you are working with corporate donors. Okay, Heidi, so I've gone through the big tax changes I wanted to talk about. Are you seeing any questions that I can address about that right now?
It does not appear.
Okay, okay.
Like
So
everybody,
let
if you
I
do have
had,
questions, please
yeah,
feel free to just drop those in the chat, and we'll keep an eye out that. GP, you had something?
yeah, Katie, I had a question for this particular one. This is not just for C corps, correct? This is for all corporate structures.
Well, not exactly, because other corporate structures, so partnerships, S corporations, they're not taking those deductions. Those deductions are getting reported separately on those tax returns and flowing through generally through like a K-1 to the individual owners, and the owners then are taking the deductions specifically. They'll report it, but it's not going to change or impact the amount of tax that the business pays. It's all flowing on through to follow then the individual taxpayers' tax rules.
Thank you.
Sure. Okay, so how are these donors reacting to these changes? The way I see it, you end up with two donor groups. One is going to be your smaller donors. These are going to be individuals, maybe medium level income, small business owners who have never made a donation or maybe haven't donated since 2018 when they stopped itemizing their deductions. And you're going to want to look for strategies on how you're going to reach them and let them know that they may be able to be eligible for a tax deduction on their contribution. The major donors are a little bit more interesting because they've got primarily three different strategies to bring out and use to kind of manage that tax benefit, desire to give, and how that's all going to work. And so those are donor advised funds, bunching, and qualified sponsorships. Are you seeing an increase in any of these types of strategies from your donors? Any interest, questions from donors, wondering what the heck to do with all of this? I am going to talk and explain a little bit more about DAFs here on the next slide. So I will try to cover as much of that as I can because I know this is a really, really hot topic right now. So think of this as just your basic survey intro level DAF course. Donor advised fund. So there's three parts to that. So you start with your donor. The donor can be an individual or it can be a corporation, and they give assets or stocks to an account managed by a sponsoring organization. Sponsoring organization could be a community foundation. It could be a charitable arm of a big investment firm like Fidelity Charitable. There's a lot of different ways that these funds can get set up. when you set them up, depending on who you set them up with, the donor may have advisory privileges over the investments. They don't have control over what the DAF investments, but they may be able to direct some of their money to different investments. Think of it kind of like an employer's 401k plan, where you don't get to choose what investments you can choose from, but you can make some choices within a predetermined selection. So the way this works is the donor puts money in to the DAF with this sponsoring organization, and they get the immediate tax deduction in the year that they make that gift. That's because the DAF sponsor is a 501c3 charity, and they now own that contribution. The original donor can come in and recommend distributions to different nonprofits, but the DAF, as the owner, has the ultimate authority in what distributions are paid out and to whom. The benefit to this is that it can separate the timing of the donation and the tax benefits from the actual giving and support to the charitable organizations. These have gotten a lot more popular in recent years. They're easier to set up than private foundations. And the donors then can continue to contribute assets over time when it makes financial sense, and then make decisions to give as they see needs arise. So why are these popular with the donors? Well, again, they can contribute appreciated investments, other things, and avoid capital gains tax, because all of that then goes into the 501c3 DAF sponsoring organization. They get that big charitable tax deduction on the front end, and then they can give on a regular basis whenever they want, regardless of the timing of when they've put those funds into the DAF. Things are a little bit different on the not-for-profit side. It's important to understand that getting a email from a donor saying, hey, I just talked to my DAF and they're going to send you $20,000. That should not be treated the same as a pledge from a donor. For DAF purposes, because the fund is the owner and has the legal determination about what goes out, you don't recognize revenue for that contribution on your books until you actually receive it from the DAF. And so that kind of gets into this whole idea of your legal owner versus your relationship owner. The legal owner is the fund. That's your community foundation. That's Fidelity Charitable. That's DAF 360. Your relationship owner is the original donor. And so you kind of think about it, your legal owner is the one who's going to get the gift acknowledgement from the organization, and is the one who's going to be listed on Schedule B of your 990 with your other major donors. Your relationship donor, this may be the person that you just send a handwritten thank you note saying, hey, we got the gift from your DAF. Thank you so much. We appreciate your support. They're going to want to hear updates about your mission, be involved in different things going on. So they're very, very different relationships with different acknowledgments and just different things to be keeping in mind as you start to see more contributions from donor advised funds. Now, donation bunching is similar to DAFs in that the donor's goal is to maximize their tax deduction. This I would expect to see more often when you've got a donor with one or two organizations where they really want to focus their support. And the way the strategy works is that the donor will give kind of an unusually big gift in one year to cross the threshold and maximize their charitable deduction by itemizing on their tax return. And then they'll give a smaller gift or maybe no gift at all for the next couple of years and take the standard deduction and kind of go through that. The analogy I've heard is, think about your local grocery store has offered you a 10% discount if you spend $100 or more in a shopping trip. Well, you're a whole lot more likely to bunch your shopping for the week into one big trip and go in and get the most discount that you can for your trip, rather than spreading out your grocery shopping that week over several smaller ones. That's kind of the thinking behind it. So again, for donors, you're getting the same tax advantages as the donor advised funds, but this time the donor complaint retains complete control and timing of the amount of the donation. For the nonprofit, things become a lot more variable and less predictable because you don't always know when you get a great big gift. Is this a change? Are we going to get this again next year? If we don't get a gift from this donor, does this mean they have moved on to other organizations to support? Key here is talk to your major donors. Understand what their long-term giving plans are. This is also an opportunity to talk to your private foundation donors, especially if you are seeing a negative impact to your organization's cash flow as a result of these strategies. And can you work with the private foundations that support you to help make adjustments to the grants that they want to give you to help smooth out some of that fluctuation?
Katie,
Yes.
Karen had a question about DAFs before we get too far
Okay.
in. We're hearing that she says we're hearing that sometimes distributions from DAFs take a long time to get to the nonprofits. Have you found that to be true? And if so, why is that?
I believe a lot of that has to do with because the DAF has to verify that the recipient nonprofit is a 501c3 public charity. There are really, really strict rules about who a DAF can give to. What we are recommending right now is that one thing that you as a nonprofit can do is make sure that your tax EIN is very visible on your website and visible on your materials, because that's what the DAFs are looking for to be able to verify that your organization is eligible to receive a contribution. And that can help speed up the process. If the donor has it, the DAF can easily find it to help keep that moving. I think too, as they get better, and this becomes, as you know, this is just continuing to grow in popularity. We're even seeing it. This is not just ultra wealthy donors that are doing this. There are DAFs where people are setting them up with $10,000 or $20,000 just to get those set up and making smaller contributions out of them. So don't think that this is just going to be a specific group of individual donors, and don't assume just by looking at one of your donors' past contributions that they would or would not be interested or have a DAF that they would want to contribute through.
Okay.
Okay, thanks. So moving on, looking at qualified sponsorships. This is a great strategy that has a lot of potential for bringing in some unrestricted funds to your organization, but there are some significant risks if they're not done correctly. Because this is not just a fundraising tool, there is a strong compliance component to it as well. These things have been around for more than 30 years. They're great. You bring them in, offset your fundraising costs, and the sponsor then can possibly deduct this as a business expense rather than a contribution. So they can potentially, if it's structured correctly, get around any of those contribution limits. I don't remember the last time I went to a gala, a golf tournament, a 5K that didn't have a long list of sponsors. Organizations of every size are using these, and it's great. You're getting generally unrestricted income coming in from these sponsors, and it's giving you some great opportunities to develop new relationships in your community. Where you've got to be careful is that you don't cross the line into advertising for your sponsors. Advertising is generally going to be considered unrelated to your exempt purpose. And what that means is it's going to be taxable as unrelated business income. Now, we saw some updated IRS guidance that came out in January looking at specifically the issue of sponsorships versus advertising. And what we have seen in the past is when the IRS updates guidance, that is a reflection that there is either active or anticipated exam activity. Exam activity is top secret code for IRS audit. And nobody wants the IRS coming in. I don't care how squeaky clean your books and everything you do are. You don't need the hassle of them coming in and wanting to look at everything. So what you're going to need to do is avoid providing something of value to your sponsors that's going to look like advertising. And we'll get into a lot more of this, but you're going to want to make sure that everybody on your team is involved. It's not just a finance issue. Marketing needs to be on it. Your development team needs to be on it. Board members, even event volunteers need to be kept in the loop on this in order to maintain compliance.
Okay, I have a poll for that.
Okay, great.
Okay, ready?
Yes.
How confident are you that your sponsorship agreements clearly distinguish recognition from advertising? All right, we'll close this out in about 30 seconds or maybe 15 seconds. Everybody's going in it. Okay, so we have ending the poll. I'll share the results. It um, looks like this might be a good
Great.
webinar, but for those who are not quite sure, but that's good.
Okay,
I
well,
think we
hopefully
can
I will
address
give you
that.
some good information to feel more confident about this and to know if you're not where you're supposed to be, what things you can do to get more comfortable and confident with your sponsorships. So first off is recognition. This is on your low end risk side of sponsorships. And it's that distinction between recognition and advertising where we see those problems occur. So just general acknowledgement, listing them up on a banner, running them on the slideshow that you've got going during your gala, mentioning them in social media posts, generally going to be okay. You just want to keep everything you're providing factual. You don't want to slide into promoting that business, which would be something more along the lines of trying to influence a purchasing decision. So this is what's up here on the slide is fairly safe. You're not saying anything about go visit ABC company, XYZ bank has these great deals on CDs right now. You're just very factual. They're a sponsor. We appreciate them. Leaning more down to the higher risk, really one sentence can create an issue for you. And it generally doesn't happen in your sponsorship agreement. It happens during your event. What happens is we get really enthusiastic presenters, whether that's your board member, your executive director, somebody has gotten the microphone, and a spontaneous recognition can cause all sorts of concerns, even if all of your written materials are compliant. So if you can, giving speakers prepared language to use is a way to avoid this. I sit on the board of a small nonprofit where I'm the board treasurer. And we had our gala last month, and a local jewelry store donated a pair of earrings and a necklace to be raffled off. We had one of our leading volunteers come up and do the raffle drawing, and she was so excited and was talking about how great the jewelry store was and how long they'd been in the community and who was running it and just how appreciative we were. And then she said, "You need to go down and visit them." And we crossed the line right there. And that's a conversation that I, as board treasurer, need to have with the executive director and the rest of the board. And we need to put in some guardrails in place to make sure that we don't do that again, because that is really putting the organization at risk with something like that. So a little brief compliance checklist that you can use as relates to sponsorship. And this is really kind of focusing on your governance policies. You need to have a process in place and use it. First thing, standard sponsorship agreement. All your sponsors, all your events. And be aware, the IRS is going to look, if they were to come in and look, they're going to look at the substance of that arrangement, not just the title on it. You just can't say this is our gold sponsor agreement and then go in and say that you're going to provide discount coupons to the for the sponsor's business on all of the tables at the gala. You've just crossed that line there. It's super important to involve your development and your finance staff in the review process. You've got development over here on one end, really focusing on relationships and revenue generation. You've got your finance people making sure that reporting is done and that you're staying compliant with IRS regulations. Those are equally important and really need to work together. You've got to understand what your organization is promising the sponsor and who within the organization has authority to approve sponsor messaging so that we're making sure that we're not crossing that line. I recommend you keep copies of everything related to events where you have sponsors. So that would be the contract, any programs, screenshots from social media, screenshots from your website. If you've got a slide deck that you use, keep all of that, any communications with your sponsor. That will help document your commitment and your intent to stay on that recognition sponsorship qualified side of the arrangement. I recommend you periodically review your sponsorship portfolio as well. You know, are there certain sponsors that are getting a lot of benefit out of this? Have your arrangements changed over time? Have you slowly slid into a little bit of possible advertising so you can get those corrected? You're never going to be able to eliminate the risk completely. The goal here is to try and identify those potential risks and get ahead of them before they become real IRS issues. Now, full disclosure, most nonprofits are not going to face an IRS examination on their qualified sponsorships. That's just kind of the economics of the deal. But that doesn't mean you shouldn't do things the right way. And good documentation, consistent procedures are going to help you reduce that risk. Really, it's just a question of providing best practices. Now, one aspect of sponsorship that doesn't always get looked at is reputational risk. Now, not every sponsorship is going to present a tax risk, but there can be risks to your reputation. Do the relationships with your sponsors align with your organization's mission? Now, this can be really, really important. Let's say you work in healthcare, education, youth programs, the environment, maybe even just some of the different social service agencies. Or what this business that you're talking about bringing on as a sponsor is what they do and their messaging to their customers and the public. Does that work well to link your name with theirs? Do you have donors or program participants or beneficiaries who might question that relationship? Is your board comfortable defending that relationship publicly if questioned about it? The relationship goes viral. If you wake up one morning and it is all over Instagram and Facebook and TikTok and every other thing you can think of, is leadership comfortable explaining, yeah, this is who we're partnering with and this is why? Most sponsorship decisions are really good decisions. It's just ensure you that you've thought about what your objectives are, tax compliance, and those reputational considerations before you sign the sponsorship agreement.
We
So, okay,
have,
Heidi, I was
yeah,
going to say, any questions about those
yeah.
sponsorships?
Oh
I know they
yeah.
are a lot.
The chat lit up. The first one is from Caroline. If you wear an event t-shirt to a sporting event so that you can get a discount in the park, would that be considered advertising for that venue?
It depends on what the arrangement was with the venue and the, you know, are they offering that discount to everybody? Did they pay to have their name put? Is the venue's name on the t-shirt? There's a lot of different things. If you could show up at a venue and get a discount from the business if you're wearing your t-shirt from your organization. Is that what the situation is?
I'm not sure, Caroline. If you want to, you can either write it in the chat or you can unmute yourself. All right, we'll swing around and I'll see.
Okay.
Uh, Margaret from the Children's Museum of the Upstate, real close to me where I am. So sponsor tables where sponsors hand out business brochures or offers is a no-no at this point.
That I would say having like just brochures is probably right there on the line. Handing out discounts, that's crossed it. That is a big no-no because now you're helping them advertise and you don't want to do that.
Courtney asked, what about sponsorships from another 501c3?
Oh, that's different. That's completely different. We're talking about agreements with for-profit businesses.
Right. That was a good
So
question.
that they're taking advantage of a business deduction to support your organization and getting a business benefit. You're getting money from them and they're getting a business benefit in the form of advertising. With another nonprofit, that's not an issue. This is for-profit businesses that's where the issue comes in.
Karen Nichols asks, as a community foundation, are we responsible to enforce this with our component fund nonprofit fund holders if having a fundraiser to raise monies for their fund? We have a fundraising policy, but may or may not be in attendance at their fundraisers.
You've set the policy, you've provided it to your component organizations. I think that's got I would think that had the foundation covered. You may want to talk to your tax people about that to get a little bit more certainty, but the onus then is on those component organizations.
Adrienne Woods of Safe Passage has a really great question that I think we see a lot at conferences, and that's that swag bag. So,
Mhm.
is sponsorship merchandise in an event swag bag considered advertising?
Not necessarily. And some of that, again, you're going to want to kind of talk to your personal tax people about this, but there tends to be some kind of safe harbor on items of minimal value. So think about a magnet, a pen, a chip clip, those kind of little things that just have the business name on them really tend to fall under that.
Okay. And then let's see. Um, Caroline, the venue is giving the discount. Caroline is coming, circling back. The
Yes, yes,
venue
yes.
is giving the discount to a particular MPO for attending that particular game where the MPO is featured. So they wear the
No, that's
t-shirt,
not
they get a
because the
discount.
NPO has not, I don't think the venue has given the NPO, paid the NPO to promote them. This is a giving back, and this is that I think that all kind of falls into the venue's charitable contributions. So that would not be considered a qualified sponsorship. Really what you're looking for is an agreement between a business and the nonprofit. That's where you're looking for is a written agreement, and the business is giving money to the nonprofit. And that's you just have to watch what the nonprofit is giving the business in return. That's the relationship that can cause some problems.
Yeah, GP, do you want to mention that? Why don't you
Yeah,
mention?
Katie, tell me if I might be wrong though. So, I am by no means the expert, but when I was hearing that, I was thinking of what's a good question to ask ourselves that helps us
Mhm.
give us some level of of a line. So, is a good framing question maybe, does the sponsorship encourage sales through means unique to the sponsorship arrangement? So, if
Yeah.
you are doing something that is incentivizing a sale, but that is not available outside of your door, that is sort of that
Yeah.
might be a good line to think
I
about.
think that's a good line to look for. The other one that I hear a lot is calls to action. So get on down there this weekend while they're having this great sale. Stop by and say hi. Tell them thank you for supporting our nonprofit. Anything that's calling on the attendees at the event to do something for that business. That's the call to action, and that crosses the line too into advertising.
Okay, great. Thank you.
Okay. All right. Awesome. Okay. All right. So let's move into action. All right. So when the tax changes, they create opportunities and challenges, but they're not going to replace your fundamental fundraising techniques. Donors care because they care. The donors give because they care about your mission. Tax rules may affect the timing, the structure, possibly the amount. And the better you understand those distinctions, the better prepared you're going to be in position for the future. So let's turn these opportunities and challenges into action. Please feel free to pop in any of these as we talk through them, or what you see on this slide, anything you've already tried, and how well it's worked for you. Number one, we're going to get those standard deduction donors re-engaged with your organization. Now, that new deduction I told you about way at the beginning really shouldn't dominate your message, but it can remove the barrier to giving for some people. Think of it as a door opener rather than the primary reason these folks are going to give. One of the items on that bullet list, recurring giving. I love recurring giving programs. I'm a big fan. And if you've heard any of the NPR quarterly campaigns, you know NPR is one of many that loves these recurring donor programs. What happens if you're not familiar with them is your donor will sign up for an automatic withdrawal. Usually it's monthly. Usually it's probably a pretty nominal amount, $10, $15, $20 a month. The NPO then is getting a steady, predictable revenue stream, and you can get more smaller donors to get in on that and just kind of provide that smoothing of the cash flow and smoothing of the revenue to make budgeting and planning easier for you. Those major donors, these are the ones you want to talk to about the timing of their major gifts. It's going to be crucial that you understand donor intent. That big gift in 1 year doesn't mean it's a permanent increase, and no gift doesn't mean you've lost that donor. Having those conversations, understanding and strengthening those relationships are going to matter more for you and that donor and long-term relationships and support than the actual gift amount in any given year. And that's what you want to build. You want to build that sustainability and continue to nurture that relationship with your donors, regardless of when and how they want to give to you, because you don't want to inadvertently discourage them from continuing to give. Becoming DAF friendly. So I mentioned this earlier. Is your EIN easily visible? Because those have to be verified before the DAF will authorize a gift to the organization. I've heard of some organizations that have added this to their pledge cards as an option. Do you want to give through a DAF so that they can help and negotiate that and make sure that the donor has all the information they need? It's going to take a little more effort on your part to understand who the underlying donor may be when you're getting a contribution from a DAF. It's not the sponsoring organization. And the sponsoring organization isn't necessarily going to share that information with you. So it's going to take some more effort to nurture that relationship, watch donor patterns. You should be so lucky that you've got a donor who normally gives a $15,000 gift every year, all of a sudden stops, but now you've got a $15,000 a year contribution coming in from a DAF. That's when you want to kind of ask some questions and see if there's a relationship between those two. If you would like to learn more about donor advised funds, I mentioned the CLAconnect.com website. We did a webinar last week on this subject, all about DAFs. The recording of that is up on the website. If you have any trouble finding it, my email's at the end of the slide deck. Email me and I will get you the link to directly where it is. I think I'm relatively in the know on how all of this works, and I learned a lot in this one. So I would highly recommend, if you've got 45, 50 minutes to spare, to take a look at that and get some additional information about donor advised funds. Corporate donors. Let's review your giving same strategies that your major individual donors do. Ask them, how are those tax changes affecting their philanthropic budget? The answer may be not at all. But your goal is to understand how that company is making its giving decisions. I know I'm repeating myself, but get those conversations going. Talk to them. This is how you build those relationships, keep those long-standing donors there, and continue to be able to fulfill your mission. Now, while you're out there building stronger relationships, let's keep in mind there are some risks out here. These are kind of like the top 5 I came up with. Number 3 is that big one. Those donor advised funds are not necessarily going to tell you who the relationship donor is. Who is that who funded it? Who is that really believes in your organization? So you're going to need to do some work to do that. If you've got any good strategies that you've come up with that you're willing to share, please put those in the chat. Let your companions in this journey in nonprofit understand what you're doing. Number 5 is another one I want to point out that has a couple of things to watch for. Now, you've got the obvious issue is what happens if one of your bigger donors suddenly decides to focus their giving somewhere else or just stops giving altogether for whatever reason. That's a risk for you. There's also a tax compliance risk. Part of your Form 990 that all public charities have to complete is Schedule A. For most of you, that means you're completing the public support test. What the IRS wants to know is that you are getting broad public support, that you are not limited to just a few large donors that are keeping you afloat. You're much more sustainable long-term if you've got a broad base of support. So they measure that, and they measure that every single year and keep a 5-year running total of what your percentage is. You've got to keep that number over 33.33%, or you are in danger of being reclassified as a private foundation, which is a different tax form to file and a lot of other headaches that you really don't want. So this is something that your tax professionals should be monitoring for you and that you should be keeping an eye on. The reason I bring up big donors in this is that if you have donors who are giving you in a given year more than 2% of the total donations or total donations and program receipts that you get during a year, they are considered substantial donors. Anything in excess of that 2% total is classified as an excess contribution and is taken out of your support number in terms of calculating what your public support percentage is. So having several, 3 or 4 really, really big donors, while it's bringing more money in, can actually pull your public support percentage down a little bit. Not necessarily a bad thing, but something to keep an eye on so that you don't jeopardize your public charity status. Let's see, anything else I want to mention? So yes, so tax law changes, what they're going to do is magnify your existing fundraising risks. They rarely are going to create new ones. Your best long-term response, strong donor communication and diversification. Excuse me. So we've had lots of changes just in the last few years. Tax Cut and Jobs Act, with all that uncertainty, changing the standard deduction, getting rid of the exemption, and making so many more taxpayers use the standard deduction rather than itemizing and getting a deduction for their charitable contributions. Then we had COVID with economic uncertainty, inflation, market volatility. And now we've got this new round of tax changes. What has not changed in all this is why donors give. They give because they care. They give because they believe in your mission and because your organization has earned their trust. Tax incentives rarely generate generosity. They just change how it shows up. So if somebody stopped giving you a check every year and wants to contribute through their DAF, you got to be able to roll with that. Maybe they want to give you a gift of appreciated stock. Maybe they want to give once every 3 years instead of annually. You don't need to get too concerned and hung up on the new tax rules. Just have enough knowledge to be able to have informed conversations with your donors. To kind of wrap up, these deduction changes are just one piece of the larger picture that are affecting nonprofits and their environment all over the place. We've seen over the last year and a half shifting government policies, changes to funding streams, increased demand for services, and growing competition for philanthropic dollars. We're not going to be able to predict what's going to change next or how every donor is going to react to that change. You're just going to need to know that donor behavior may change and be ready to talk about it. Ask questions, listen to your donors, understand what motivates them, how they want to give. The tax law is going to give us some clues to that, but you're only going to be able to get the answers from your donors. So that's what I've got. And I'd like to see if we've got any other questions.
All right. Well, first of all, that this has been so much great information. I love how practical you made those, especially those final slides about here's what you can do. So thank you for that. If you have a question, feel free to write it in the chat, or you can just unmute yourself and ask yourself.
Katie, I want to piggyback off something Carrie wrote in the chat that they're going to add a DAF specific web page
Mhm.
to help with all of that, and I think that's a really good idea. But I also I guess want to echo that and say, it's to your point, Katie. People want to give to your organization. You just have to make it very as easy as possible to do so,
Yeah.
given
Mhm.
the policy infrastructure that they may be paying attention to, not driving their decision to give, but it sure makes it easier when, well, we're not all financial planners, nor am I pretending to be one, but it's great to be able to have that conversation with a donor of, yes, pick your avenue. And so
Yeah.
I wonder if those
Yeah.
online resources for donors isn't just a donate now button, but also here's
Yeah.
information on how else to give and make that a little bit sensitive to the existing tax code.
Yeah, and to understand that people are going to have different motivations. I mean, what we're seeing, especially with some of the larger organizations that I work with, is seeing this a lot of people wanting to give stock and securities, and some people kind of panic at that, like, well, we don't know what to do with that. Well, if you've got investments, or you can find a broker who's willing to work with you, and a lot of them are happy to work with nonprofits. You get those investments, you immediately convert them to cash and put them to work for you. It's not in most cases, these are given as unrestricted gifts. Sometimes they are given as restricted gifts or endowments, where they want you to hold on to them and just spend the earnings. But um, oh, the 2% rule. You are not worrying about that if you're filing a 990N, because you are much lower on the food chain, because the income, the revenue that you're bringing in, honestly, is at that under $50,000. And so really, that's the only thing you file. You don't file any of the supporting schedules. Even if you are a public charity, you won't file Schedule A, and that's where that 2% giving. It's once you start to get above that and get into the realm of filing a 990 EZ or a full 990, that you'll want to be more cognizant of who those major donors are, and that you're getting some broad public support.
Okay, I launched a poll. Which action are you most likely to take in the next 30 days? And if there's something on here that is not an option, go ahead and write that in the chat. One of the things that we want these webinars to be is actionable. And Katie, you gave us a lot to think about, a lot to do. So let's see what everybody has to say. Okay, I'm going to close this in about 10 seconds. So get your answer in. Okay, ready and share results. Reviews corporate sponsorships agreement.
Excellent.
That's the
Excellent.
winner. But really, all of these are
Yeah.
great, and we hope that you'll definitely do that. Katie, I didn't see on your slides a way to
Oh,
contact you. So if you have
hang on. I will share again real quick.
okay, that'd be great. So if you
There
have
you go.
questions, and then also in the chat, Mike was kind enough to look up that DAF fund webinar
Oh,
you
great.
mentioned, and so that link is also in the chat.
Thank you, Mike. I appreciate it.
So thank you very much. So as we wrap up today, I wanted to mention a couple opportunities for you. Tomorrow is the last day. If you are interested, if you're a new executive director or CEO of a nonprofit for less than 5 years, you're relatively new and you want to grow and learn, we offer an amazing leadership seminar, the nonprofit or the Carolina Leadership Seminars. And that happens once a month. We come together and we have great training. The deadline for applying for that is tomorrow, and that information is on our website. We also have GP. Can you jump on and mention your boot camp that you have coming up?
Yes, of course. In August 12th through 14th, we are having our second annual virtual advocacy boot camp. Don't worry, it's not all 3 days or all day. It's just an hour each day. It's really targeted for those who are brand new to advocacy or thinking about it, or if there's someone on your team has expressed a little interest, or you're finding politics drifting into your mission more than expected. It's a great training to go through. So it's a 1 hour each day. How to be an effective advocate is day one. The legislative process in South Carolina is day two. And then day three is focused on our guiding principles on advocacy, which is a new chapter in our guiding principles document that we released earlier this year. So join us, open to all of our members.
Yeah, and that is actually August 10th, 11th, and
Oh,
12th.
sorry.
And
No,
it's
I knew it
just
was around my sister's birthday.
that's
And
okay. And it's just an hour a day, but boy, what a great way to really learn. I can't wait. Of course, this is my job, but I can't wait to learn from that as well. If you enjoyed today's webinar and you took one, even just one golden nugget, go ahead and do some claps or give a reaction on the Zoom, right in the chat. And Katie, thank you so much for sharing today.
Thank you so much for having me. It's been my pleasure. And you've got my email if anybody has further questions.